Bank of India and its latest Monetary Policy Committee meeting for financial year 25 to 26 announced a 50 basis points reduction in the repo rate, bringing it down to 5.5%. With this financial decision, the Monetary Policy Committee also made certain changes in other ratios and projections. So let's take a look at some key highlights of the Monetary Policy Committee's June meet. Plus, how is the decreased repo rate going to affect home loans, EMIs and your FDs? And what is repo rate actually? Let's take a look in this episode of News Watch. First things first, repo rate is an interest rate at which RBI lends money to commercial banks, also known as repurchase rate. It is set by the Reserve Bank of India. In India, the Monetary Policy Committee is in charge of determining the repo rate. So how does it work? When banks need funds, they borrow money from the central bank by offering government securities as collateral. The banks agree to repurchase these securities at a later date for a higher price, which also includes the interest. The policy repo rate was reduced by 50 basis points to 5.5% with immediate effect. This is the third time that the RBI has cut the repo rate this year. Through this reduction, the RBI wants to stimulate economic activity by making borrowing cheaper for businesses and consumers. Consequently, the standing deposit facility rate now stands at 5.25%, while both the marginal standing facility rate and the bank rate has been adjusted to 5.75%. The Reserve Bank of India also announced a reduction in the cash reserve ratio by 100 basis points, lowering it from 4% to 3%. This reduction in CRR aims to enhance liquidity and reduce the cost of funding for banks. The RBI has shifted its policy stance from accommodative to neutral. In its previous meeting in April, the Monetary Policy Committee had decided to change the stance from neutral to accommodative. The RBI also revised the inflation outlook for financial year 26 downward to 3.7% from the previous 4%, reflecting a more optimistic view on price stability. The RBI has maintained its real GDP growth forecast for financial year 26 at 6.5%. This is based on sustained momentum in private consumption, investment and services sector activity despite global uncertainties. So now with the latest repo rate cut, how will it impact your home loans, EMIs and FDs? The repo rate cut is expected to provide relief to borrowers with loan EMIs likely to go down. Banks will react with reduced interest rates on home loans, making them more attractive to borrowers. This repo rate cut will immediately lower the interest rates on most loans, hence borrowers get benefits from a repo rate cut. For FD investors, especially senior citizens who rely on interest income, a cut in repo rate means lower returns. If banks reduce rates soon, new FD investors will earn less than those who locked in at earlier higher rates. A lower repo rate can lead to higher inflation as increased money supply and lower interest rates can drive up prices. It can reduce the interest earned on savings, making it less attractive for individuals to save. In conclusion, generally when the repo rate decreases, the cost of borrowing increases and loans become cheaper. There's an increased consumer demand and also high inflation risk. So what do you think of this decision by the RBI? Let us know in the comment section below and keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.